Hello and welcome to episode 5 of Talking Central Banks podcast with me, Karan Medici. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about the 25 ECB monetary strategy statement, as well as other nuances in ECB policy. Our guest tonight is Andre Chelhot, who is the Chief Economist at the Prague Finance Institute. Andre began his career at the Bank of Canada and later served as chief economist at the Olayan Group, one of the largest family investment groups in the Middle East. His work bridges global economics, geopolitics, and financial markets with a focus on debt, trade, and the shifting world economic order. At PFI, Andre leads research and dialogue on the forces reshaping the global economy. Welcome to the show, Andre.
Thank you. Thank you for having me. Thank you.
My pleasure. So, Andre, let's start with the elephant in the room. What impacts on the tariff wars do you see on the European Union as of now?
In the beginning, when President Trump started to announce tariffs, everybody thought that these tariffs would be offset by a weaker currency of the exporting nations. So we all expected that the euro or the Chinese yuan will start depreciating in order to offset the impact of the tariffs, and European exporters would remain competitive. But what took place is actually the opposite. In the same time that the US has imposed tariffs, or a bit before, the euro has started to appreciate by a very, very fast manner. So the Europeans now are squeezed. They are, one, hit by tariffs that makes their exports less competitive in the international markets, especially in the American market. And two, the euro is becoming more expensive. Now, of course, the European model is based, or till now has been based on exports and on manufacturing. But I think that what market participants have maybe minimized, let's say, is the shift of the European economic model from relying on exports to be relying on domestic demand. And here we see governments in Europe boosting fiscal spending, be it on infrastructure or be it on defense. So to answer your question, is that there is no doubt on the European exporters, it has been a disaster because of the rise in the euro and because of the imposition of the tariffs. But again, from the other side, you are seeing some sectors of the economy doing better than expected, especially in infrastructure or heavy industry or defense. And if you look at the confidence numbers, the recent ones, we have been on an upward trend in the confidence numbers in the Eurozone for the last 6 to 9 months, to the point that now, if you look at the PMIs, for example, you can see the European nations, not only the southern nations that have been supported by foreign investment in real estate, but also the northern nations are starting to see a comeback in economic activity. And PMIs are now above 50. So a conclusion, it depends on the sectors. The exporter sectors have been hit. The domestic sectors are doing well. The strength of the euro, which was unexpected, has helped in taming inflation. This is why it has allowed the ECB to cut rates, and now the ECB policy rate is among the lowest in the world, except for Switzerland and Japan.
From the central banking perspective, Andre, what steps do you think the ECB must take to address the fallout pertaining to the export economies, primarily Germany, Italy, and to an extent France?
Yes, if we are going on a path of a shift in the economic model, as I explained before, then monetary policy should support that shift and should have an accommodative stance in order to support that shift. So if you lower interest rates, you will encourage investment spending, local domestic investment spending, and also you will reduce the cost of burden of the debt of the European governments, but we will go to this subject a bit later on in the podcast. But I think that the ECB mission in that case is to allow that shift to take place and not to stand in front of it, even if that shift would require a reallocation of resources, which means that it can have a temporary rise in the inflation rate because you are reallocating resources. But the ECB should not fight that reallocation, should actually help to make it happen.
Right. From the banking perspective, Andre, I mean, obviously, for that shift to happen, banks must also be strengthened. But the ECB, it seems, is prioritizing small and medium-sized banks in its reform efforts. What is the rationale behind this move, Andre? And do you think the emphasis should be more on the larger banks, given the stability that they offer to the entire system?
Well, here there is also a social dimension to it because one, the small and medium banks are mainly regional banks, and they support regional economies and they protect regional employment. The big banks are not interested in that market. And I don't know how to force the big banks to lend to the private economy. The big banks are mainly interested in buying government bonds and sit on them, or lending to very large corporations. So I don't think that it is about capital, but it is more about politics and about society. So I think that if the small and medium banks are encouraged to lend to the private sector, and this is what has to be done, I think the ECB should create a backstop for these banks in case something takes place, like a crisis. But I think that the ECB prioritizing credit to the private sector is a very good move, again, in order to make that shift in the economic model taking place.
The global uncertainty index released by the IMF is at its peak, Andre, as we speak, as trade uncertainty is also at an all-time high. How do you think this volatility impacts the monetary policy of the ECB in the near future?
Well, this is a common theme for all central banks because the uncertainty index is rising everywhere. So it's not only the ECB that is facing this problem. Right. Let's a bit compare the situation of today to the situation between the year 2000 to 2020. You had a secular decline in inflation rate, you had globalization, and you had a certain world. So in that environment, the work of the central bank becomes much easier. Now you have an uncertain world, and uncertainty in trade, in capital movements, create uncertainty in policy setting. So I think that the volatility in macro data should not translate in volatility in policy setting. The policy setting should not follow the volatility in macro data, should lean against it. What does it mean? It means that if you have a supply shock hitting your economy, be it the US or be it the Eurozone or be it Japan, the monetary policy should stay on the side, let the supply shock take its place, let the prices go up because of the supply shock, and then set monetary policy after this supply shock has been absorbed. The the function of the central bank is to focus on demand, is not to focus on supply, because the central bank has no tool to find a solution for a supply shock. Fiscal policy has the tools. Investment policy is the tool. Trade policy is the tool. Monetary policy cannot respond to supply shocks. So that volatility that is coming from supply shocks is not I think that is not in the scope of responsibilities of a central bank. So this is why the central banks should ignore these volatilities.
Any impact on domestic consumption you see, Andre, panning out, especially given the background that we are in right now? Do you think in terms of rate setting, in terms of how the rates will evolve over the next 2 quarters?
You mean consumption spending in Europe?
Exactly, to spur the consumption. Consumption might be impacted because of the supply constraints, the tariff wars ongoing, and the skepticism that the households might have in terms of future spending.
Well, the US was hit by a negative supply shock. And I'm going to get to Europe now, but it's the US who's getting the negative supply shock. And it is the US that is seeing a rise in import prices. And it is the US that is seeing a decline in disposable income. In Europe, we don't see that, because in Europe, actually, the euro has gone up. So inflation has come down. And real disposable income is not that weak, or it didn't weaken because of the tariffs. So the lowering of rates from 4.25% to 2%, and maybe the ECB will lower them again by 50 basis points over the next few months, this will encourage private spending, and also will encourage consumption spending. So we don't see a spike in import prices in the Eurozone that will affect disposable income. We are not seeing that, and I don't think that it will happen.
Talking about the ECB monetary policy strategy statement for 2025, Andre, the statement argues, and I will read, that the ongoing structural shifts related to geopolitics, digitization, artificial intelligence, demography, the threat to environmental sustainability, and changes in the international financial system suggest that the inflation environment will remain uncertain and potentially more volatile, with larger target deviations in both directions, posing challenges for the conduct of monetary policy. A more resilient financial framework is therefore required. Given this background, Andre, how do you see the ECB reacting to address these challenges that are just listed on the statement?
I think that if they continue on being obsessed with price stability and 2% inflation target, and I'm weighing my words very carefully here, because we're going to get to the other subject that is much more important than price stability, is that they need to have a band, and that band needs to be flexible. Because when you are the central bank of a nation, and that nation has a massive amount of debt, all nations around the world are in that case, except for a few countries. But if you look at Japan, you look at European governments, except Germany, you look at the US, you look even at China. So when you have the state that has a lot of debt, de facto, the monetary policy loses a lot of its independence. And this is why I think that central banks, they should admit that they are losing their independence, and they should gradually be more flexible on inflation targeting, accepting a band of maybe plus or minus 2% around the 2% objective. Now, I know that we're going to talk about the symmetry in your podcast, in your questions, but here I'm going to open a subject which is very important, and which is the debt of these nations. You see, we don't believe in the independence of central banks. A central bank is, at the end of the day, the bank of the state. And it's the state that decides what to do with money. How to tax people, because taxing people is taking money out of them, and how to spend on people to give them money. So the state, when you arrive to a point where you have 100, 110% of GDP in debt and even higher, then you have two ways to solve this problem. You don't have another one. You solve it either by creating inflation or allowing inflation, or you solve it by turning your primary balance deficit into a primary surplus. And that will involve cutting spending or increasing taxes. Increasing taxes, I don't see it happening in the near future. Cutting spending, I don't see it happening also. We tried it in the US with Doge, it did not happen. So the US is now doing other things to get money out of the system into the coffers of the treasuries, which is tariffs. But also, the most important thing is that there is a lot of pressures on central banks to lower rates, despite the fact that you have inflation above target, because at the end of the day, if the debt explodes, there will be not only high stability, but I'm afraid there will be no central banks left. So the first thing that you should do is, first of all, to admit that you have a debt problem. You have to help in managing that debt before you attack a subject of price stability. This is why I think that central banks will be obliged at the end of the day, and including the ECB, to adopt an inflation target, whatever it is, 2% or 2.5%, whatever, with a band. Now, in the case of the ECB also, which is very, very interesting, is that the ECB is the central bank of 20 or 21 Eurozone countries, which means that these countries, they don't have independent monetary policy. So you might have debt problems in France, where you have 115% of GDP, and then you have no debt problem, let's say, for example, in, Germany, where the debt to GDP is no more than 70%. So what are you going to do as an ECB? You're going to stay on targeting inflation while letting one of the main members of the Eurozone going down? Then the ECB will cease to exist. That's it. The euro currency will cease to exist. So market participants and economists, in my opinion, they should start focusing more on what is important for a state and less what is important for the prestige of a central bank.
Reading the statement, Andre, and also listening to you when you were talking about the price stability objective, I can't help but wonder why they are so much concerned about other aspects of the evolution in the economy, including digitalization, AI, demography, environmental sustainability. Don't you think focusing too much on these factors basically deviates them from their primary objective of price stability?
Definitely, they are not focusing enough on many factors other than price stability. They're not factoring them in their models. Their models are very simple or like very basic models that, based on the output gap, based on the Phillips curve, based on other theories. But maybe they will include the AI revolution at some point and its impact on productivity. We are not sure yet what the impact on productivity of AI, but they need to be more flexible in order to allow these shocks to be absorbed by the economy and by the markets, the free markets of the economy, and to be on the side. They cannot, every time they have a supply shock and inflation goes to 6-7%, and they say, oh my God, we have to tighten monetary policy and we have to kill demand. No, cannot do that. Now, during COVID, It's the opposite that happened during COVID. And even the ECB, you see what happened is that you had in the same time a very expansionary fiscal policy in all over the world because the governments were very worried about economies going into depression. But in the same time, you had a very, very aggressive easing of the monetary policy from in the US from 3%, boom, down to 0%, while you are giving to the economy a push of $3 to $4 trillion in fiscal support. This is insane. This is what created inflation. And they had to hike interest rates all over, be it the ECB, be it the Bank of England, be it the Fed, to hike interest rates very aggressively because they were going out of control. Not because COVID caused a supply shock only. It's because the governments have, in response to a negative supply shock, they engineered a positive demand shock. So the gap between the two became so immense, so inflation went up all over the world and including the Eurozone.
Coming back to the household consumption story, Andre, under the ECB monetary strategy statement of 25, the Governing Council confirms that the harmonized index for prices, which is HICP as it's called, remains the appropriate price measure for assessing the achievements of the price stability objective of the central bank. What are your views on this, Andre, given the volatility that we are currently in at this time?
The headline inflation number is more sensitive to oil prices and to the exchange rates. The core CPI is less sensitive to, of course, energy and food, but also to the exchange rates. So I would think that, if a central bank is, again, still obsessed with price stability and maintaining a low inflation rate, again, targeting the core inflation is more effective than targeting the headline inflation rate. I used to work at the Bank of Canada, by the way, and the price stability phenomena started when I was a young economist. And back then, the Bank of Canada immediately thought that, no, we should target core inflation, even though that the Canadians were major exporters of oil, by the way. And in order not to have this volatility in energy prices and in the currency affecting our policy monetary settings. So yeah, the ECB targeting headline inflation is something that I don't understand. Something a bit unusual. Let's put it this
way. Is it because of the energy volatility, Andre, especially after the cutoff of Russian oil supply lines?
Yes. Well, yes. If you have very volatile energy markets or imports of energy, very volatile and subject to global threats or geopolitical threats, yes, makes a lot of sense to take it out from to take the energy out of the CPI and to focus on the core. But then again, here we are going back to a subject where this obsession with price stability and inflation targeting, I think that this is behind us. This can be done in a world where certainty is high, in a world where everybody is friends with everybody, and in a global world. The goal of targeting inflation is, I think, will become sooner or later obsolete. It will not serve anything. You won't be able to target inflation in that world.
Interesting. Regarding its objectives, Andre, the ECB strategy statement suggests that it will focus on growth maximization along with other objectives, as we were also talking about that earlier, as stated under Article 3, while maintaining its focus on price stability. And I think that we can argue about that. But do you think that since inflation has been more or less contained, growth has become more necessary, given that full employment cannot be achieved without it?
Well, the ECB has lowered interest rates, and it has done the right move to lower interest rates. They were, aided by the fact that the euro has strengthened a lot and inflation has come down because of that. But that was the right policy move to lower interest rates. I think that a euro that stays at these levels will allow them also to lower interest rates even more and to support domestic demand. So I'm not that negative, by the way, on growth in the eurozone, unless if we have a fiscal crisis that is not being resolved fast. For example, if you have French yields going up to 5-6%, and the ECB is not intervening, and there is no solution for that, then yes, then you will have a big, major problem in Eurozone countries. But for the time being, the Eurozone is benefiting from low interest rates, from low inflation, and employment, by the way, in the southern countries is doing very well. It's only in the northern big countries it's not doing well, I agree. But again, we go back to my first subject, which is the shift in the economic model. You might have a shift in employment from the industries that are exporters to the industries that are focusing on domestic demand or in the service industry. By the way, there's a lot of also migration from the manufacturing industry to the service industry in Germany. You can see that in the business sentiment indices, where the service industry is like doing very well and the manufacturing industry is not doing well at all.
Agree. Staying with the models, Andre, you were talking about the evolution of the reaction function. It might include AI as a component. But how do you see the ECB's reaction function evolve over the next couple of years, given the reality that the ECB is facing right now in terms of the geopolitical risk, as well as the other risks emanating from AI and other aspects?
Okay. For the last 40, 50 years, central banks and many economists around the world, they believe that there is a relationship between inflation and the output gap.
Yeah.
So the output gap is the difference between the potential growth rate of the economy and the actual growth rate of the economy. The problem is that potential growth rate of the economy is very hard to calculate, because it depends on your labor population growth, it depends on your capital spending, and it depends on productivity. Now, labor growth in the Eurozone is not that great. Capital spending, because as you said before, banks are not lending, and now the ECB and European governments are shifting the economic model. So we might have more capital spending, and the productivity. Now, the productivity in the Eurozone, and I'm sorry to say that, but the US and China and Asian countries are way ahead of the Europeans in terms of technology. I just want to give you an example, is that in the 90s, Europe was producing about 30 to 35% of electronic chips. Now they are barely at 5-6%. There are anecdotes that in the French and German government offices, you still have faxes. So in terms of technology, Europe has a lot to catch up, a lot. I mean, only the internet speed in some European countries is a joke. So I don't know how much AI is gonna raise the potential growth rate of the economy in the Eurozone, as much as it's gonna raise it in the US or in China. So I don't think that AI will have a big impact on the model of the ECB, because and the model of the ECB, as I said, is based mainly on the notion of output gap and the Phillips curve. Now, again, I say that these models have become obsolete, because now the name of the game is the state debt, and how you're gonna deal with it. So right? So I don't know if central bank governors, the new ones that are going to be appointed, for example, the new one in the US next year in May, is going to care that much about inflation. I think that he's going to be politically appointed by the Trump administration, and his function. By the way, the Fed has three mandates. Nobody talks about the third one, and the third one is to keep long-term rates at a moderate level. It exists in their mandate. So yeah, we're gonna have maybe a revolution in central banking from next year onwards.
Staying with inflation, Andre, there seems to be a discussion regarding the so-called inflation buffer in the statement, given the proximity to the effective lower bound. How do you think the ECB can achieve this objective, given that inflation is now stable? You were also alluding to this earlier, and rate hikes are out of the question at this time.
Yeah, I mean the inflation number now in the eurozone is quite close to target, and I mean they don't like inflation to go down below 2%. But here I'm gonna tell you something. When you have a massive positive supply shock hitting the world economy, preventing the inflation from going down, okay, it's very difficult. Very, very difficult. Because you need to print a lot of money in order to create monetary inflation to offset the positive supply shock. That was the case between 2010, 11, and 2020. When you have a negative supply shock, if your inflation is going down below 2%, and it becomes quite easy to beef it up very fast in a policy action that is not as strong when you have a positive supply shock. So you see the asymmetry here. You have a massive positive supply shock, inflation goes down, you need to print a lot of money. You have a negative supply shock. For some reason, the inflation is going down because your currency is going up. Then all you have to do is to engineer a weakening in the currency. This is very easy. You start selling the euro and buying other currencies, and maybe do it through the ECB balance sheet. So that buffer should be taken into account, thinking of what supply shock is hitting the economy. You have a positive supply shock, then you have a problem if inflation goes down a lot. You have a negative supply shock, you have inflation going down, it's very easy to solve it.
Right. Talking about symmetry, Andre, it seems that just like the Fed, the ECB also wants to stick with the symmetric inflation targeting regime. And I think it's a buzzword now. Do you think it's still too early to think about inflation anchoring in the near term, since things are still pretty nebulous in the current climate?
I think this is all semantics. I mean, at the end of the day, you have to see in what world you are. If you are in a peaceful, globalized world and you have positive supply shock, you are in that world, and you have to conduct your monetary policy according to that world. If you are seeing uncertainty and you are seeing negative supply shocks and deglobalization and trade wars and whatever, as a central bank, you need to admit reality and try to be flexible and to help your state in order to go over this period. You cannot fight your state.
Right.
I mean, central banks before 1993 or 1992, they were never independent, never in history. Like this is a new concept. Independence of central banks. It doesn't exist.
Yes. Yeah.
It's a myth.
I think it's more to do with central banking being established as an institution that is agnostic to the ruling government at any given time. So I think that is the reason why independent central banks have become the concept of independent central banks has become so important globally. And
look, the concept started. The concept started with, by the way, by the Reserve Bank of New Zealand. When I used to work at the Bank of Canada.
Right.
Yes.
After the inflation targeting regime, they also came up with that.
Yeah.
Even that was a trend-setting tool that they brought about.
Yeah. And then the Australians followed, and then the Canadians followed. But if you look at the history of this price stability thing, it came from countries that were suffering from chronic inflation, like New Zealand. And New Zealand is a net importer country. It was. I don't know now. I'm not focused on New Zealand anymore, but we used to trade a lot with the New Zealand dollar because it used to pay a lot of interest. And it was a country that had a chronic current account deficit. And when you have a chronic current account deficit, then you have downward pressure on inflation, on your currency, and then you have a chronic problem in your inflation. So what they did is that they had to, create a certain credibility to fight inflation and to convince the people that the central bank is quite serious in fighting inflation. And by the way, we should not forget that the price of that was a deep recession in New Zealand in order to achieve that, finally, that inflation rate. So this is a small open economy that was suffering from a chronic inflation, okay? Like Australia. Canada also was, relatively speaking, is a small open economy, relatively speaking to the US, its neighbor, or to the Eurozone. So I can understand that, small open economies are interested in adopting this policy or this model, but large economies that have a big weight on the world, I mean, a very orthodox central bank can create havoc in the world financial markets and the world economy. You have a responsibility not only for your own markets, but you have also responsibility for the world markets, since you are in a globalized economy. But now we are not anymore. So, for example, I'll give you an example. The Fed lowered interest rates aggressively in 2008, 2009, 2010, right? And that created, lots of volatility in the foreign exchange rates and caused a lot of damage in the world financial markets. So for small open economies, yeah, okay, especially emerging countries, in order to regain your credibility and you want to contain inflation and to convince people that you are serious. But for large economies that are being hit by supply shocks, I don't see where is the objective. And by the way, something else that I want to say, and I said it in my podcast last year at PFI, is that, they declared victory over inflation for 20 years. And I was at the central bank also. But 70, 80% of the decline in inflation was not coming from central bank actions. It was coming from globalization and technology and
correct.
And low energy prices, whatever you want to focus on. But very, very little came from the fact that they were responsible, or they created or they achieved price stability on their own. No, that's not true. And the proof is that they couldn't solve the deflation problem.
Even one of our governors, Andre, had the same opinion that he can end the fight with inflation once and for all. And I've always been a skeptic of this narrative. The fight against inflation can never be won. I mean, you can always be on the defensive side, but it's almost impossible to be on the offensive side when it comes to inflation control.
You can win the fight against inflation as long as you have a very responsible government that doesn't have budget deficits and allocate the government resources in a very fair way between all layers of society. Yes, you can have it, but this is not the world that we are living in.
Exactly. Final thoughts on France approaching the IMF for a bailout, Andre, given the debt unsustainability post-COVID?
Talked about it in one of my Substack podcasts, Substack and PFI on LinkedIn. You have three situations here for France. The first one is that you don't have a majority government. And on the 8th of September, the current prime minister, who's running a minority government, is going to propose a budget. And that budget will be voted down by the two opposition parties. The left wing and the right wing. So which means that France will be in a deadlock scenario for the next 2 to 3 years till they elect a new president.
Right.
And I hope that the fragmentation of French politics will be resolved from here to 2027, because if you have the Rassemblement National, which is led by Marine Le Pen, and one of them becomes president and prime minister, well, then it is going to be very ugly for the euro and for the euro integration goal, the long-term goal. But before we go to there, we have to say that the French debt to GDP ratio is 115%, a bit below the US, not as worrisome as, not as high, I would not say worrisome, not as high as in Japan, but it is very worrisome. Why? Because they have a budget deficit of 5.5% to 6%, and they have a very significant primary deficit, which is about 2.5% to 3%. We came up with a rule, a very simple rule derived from formulas calculations, is that the path of the debt of any nation or any individual or any corporate is debt at T plus 1 equal debt at time T plus interest multiplied by the debt plus the primary deficit. And if you take them as a percentage of GDP, then you can arrive to the conclusion that in order to stabilize the debt to GDP ratio at any level, okay, what you need is that the interest rate cost of that debt to be equal to the nominal growth rate of the economy minus the primary deficit divided by that debt. You can see it on my Substack, the logic of the formulas, but to simplify it to the fullest, this is it. So we calculated for France, if you have in France a growth rate of around a real growth rate of 1%, okay, and you have an inflation rate of 2%, we go back now at the inflation targeting, see how wrong it is, okay? So then you have a nominal growth rate of 3%. Let's say we will stick to this 3%. Then if you divide the primary deficit on the debt level, then what the interest rates at which you stabilize that debt to GDP ratio, 115%, you need minus 0.2%. Okay? We are at 3.5 and 4 in the long term, the long end of the curve. So obviously, this is not sustainable. The only way to stabilize the debt to GDP ratio is either to accept a higher inflation rate, we go back to our first theme subject, or to reduce the primary deficit from 2.5%, 3% to 0%, either by increasing taxes or by cutting spending. Cutting spending, again, is out of the question. The political spectrum is very divided. Increasing taxes is the same thing. So you're going to increase taxes in another way, by inflation. You have to accept inflation. You have to tax people in another way. And the only other way to tax people is by accepting a higher rate of inflation. So this is why it contradicts with the monetary policy. Now, you add another layer to that problem, is that France does not have an independent monetary policy. Again, we are repeating the same subject. Are we going to see the repeat of the European debt crisis? We are already seeing the spreads gapping up to 80 basis points against the Germans. Imagine that French bonds are trading at a lower price than Greek bonds, something unheard of. Although that the Greeks, they have 170% of GDP in debt. The French have 115, 20%. The difference between the two is that one, the Greeks have achieved primary surplus, and two, most of their debt is locked at 20, 25 years with the ECB and the EU at a rate very close to 0%. So they have enough time to solve this problem. But in France, you don't have time. The average maturity of the debt is 6, 7 years. You don't control monetary policy. You have to roll over that debt. you have a fragmented political environment. You have elections coming 27, and you have the threat of a right-wing, a far-right president to be elected in 2027. So it's messy. And the only way for these things to get resolved is finally for the EU to accept a bond union, a fiscal union. Mm-hmm. You have to have a fiscal union, especially if you are preparing yourself in increasing your defense spending to 5% of GDP in order to counter the Russian threat. Fine. Okay, let's say, can France spend 5% of GDP on defense every year? Of course not. The only way for this to happen is to have a fiscal union, which is the path for a political union. But till now, we don't see anything happening calling for fiscal union. The Italians, they don't want. The Germans, they don't want.
Yeah.
The French, maybe they want, maybe they don't want. I don't know, as long as French takes the lead. And we are not very happy with our politicians in Europe. We don't see them charismatic. We don't see them like true leaders to take the step forward for Europe. We see a bunch of bureaucrats sitting in Brussels doing almost nothing. Sorry about that. I'm a bit frustrated because I live in Europe also.
So it seems that the fiscal union is a far-fetched idea for now. So I think post-GFC kind of austerity measures could be a reality for France soon.
What measures? Sorry?
Austerity measures, just like post-GFC, we saw austerity measures, which is basically a political suicide for politicians. But I think there is no way out apart from having these measures in place.
But they cannot, because they have to vote for it. And on the 8th of September, we have the vote. And he proposed austerity measures of I think 44 billion euros in order to reduce the deficit from 5.5 to 4.5, something like that. And also at the request of the IMF or at the advice of the IMF. So they cannot. So at the end of the day, I mean, they will need an IMF bailout. I think that before they go to ask the IMF, and the IMF has done that before, and they told them before in 2010, 11, why you don't go to the EU? I mean, why are you coming to the IMF, right? Yeah. And the IMF did not help much in the crisis. They helped very little with the Greek crisis.
Right.
It was an internal problem, and this is what IMF told them. This is an internal problem, an internal European problem. Solve it between you because you have the liquidity to do that. The ECB has liquidity to bail out any country, be it France, be it Italy, like bailing out any state in the US. The Fed, if the New York state goes bust, the Fed has the obligation to bail them out because it's part of the United States.
Exactly.
And, yes. Yeah. So no, I don't think that they're going to go to the IMF. But what I think is going to be a lot of political pressure on the ECB and a lot of political discussion about after the 8th of September, who is going to be the backstop of France. And the conversation of fiscal union is going to start to be open again.
Right. Before we end, Andre, would you like to talk about your Substack? I think a lot of folks out there would want to visit your channel and your Substack to get more views about your perspectives on the EU economy.
Thank you for mentioning it. Yes, about a month ago, I thought that we should deliver this research to everybody. So I started a Substack. It's called the Macro Anchor. It was inspired by an anchor that we have here in one of our properties in Greece. And Macro Anchor is a Substack where people can see interesting subjects being debated. For example, yesterday or today, I think we made a post on the UK budget situation. A few days ago, it was on France. We had made a very nice study of 5 parts on Japan's demographics, savings rate, inflation, monetary policy. So yeah, I would love if your viewers and followers follow our Substack, macroanchor.com, and it would be very nice. Thank you for mentioning it.
No problem, Andre. And that's all I have for today. Thank you very much for your time, Andre. It's a pleasure to speak with you every
Thank you
time.
very much, sir. Thank you very much. It was also a very pleasure to speak to you. Thank you.
Thank you. Thank you.